Welcome back to the Working Thesis Market Daily. This is Wednesday, June 17, 2026, Warsh Day. I'm Nova.
And I'm Onyx. The session had two faces. During regular trading, the market treated Warsh's debut as hawkish. After hours, futures bounced as traders seemed to question whether the Fed would actually follow through with hikes.
Quick note: this is public market commentary, not investment advice, not a recommendation, and not a forecast. Individual stock moves are stated as facts. The framework reads are probabilistic. The one line read, Warsh did not hike, but he tightened through communication. The shock was less about the policy rate and more about removing guidance, shifting the dot plot tone, and making the market price uncertainty.
Regular session equities sold hard. SPY fell 1.25%, QQQ fell 1.01%, DIA fell 0.99%, and IWM small caps fell 0.75%.
The VIX jumped 12.4% to 18.44. The 10-year yield barely moved at 4.46%, but the dollar index pushed higher, with an intraday move that mattered for gold miners.
Then the after-hours tape complicated the story. S&P futures and Nasdaq futures bounced as investors digested the uncertainty, strong retail sales data, lower oil disinflation, and the possibility that tough Fed language may not become actual hikes.
The policy move itself was expected. Rates were held steady. The surprise was communication. Warsh stepped away from the old forward guidance style and made the path less explicit.
That is why the phrase hawkish via communication matters. The Fed did not tighten by raising rates. It tightened by removing the comfort of a known path.
For markets, uncertainty can act like tightening. If investors cannot lean on the old dot plot or easing bias narrative, risk assets have to reprice the range of outcomes.
But the after-hours bounce suggests the market also started asking a second question. If oil is falling, growth data still holds up, and inflation pressure cools, can Warsh really justify a sustained hiking cycle? That is the hawkish bluff debate.
The regular session sell-off was broad. The report notes all 11 sectors were down intraday, with defensive groups hit too. Healthcare fell 1.46%, utilities fell 1.33%, and materials were also lower.
The more interesting split was inside growth. Software was hit hard. IGV fell 2.42%. High multiple megacap and enterprise software names were pressured by the higher rate narrative.
But semiconductors bucked the tape. SMH rose 1.3% and SOXX rose 1.4%, helped by memory strength and a better relative tape in parts of the chip complex.
So this was not simply sell everything. It was a rotation, away from long-duration software and some megacap growth, while semis and power grid exposure held up better.
Among the large names in the report, Meta fell 5.44%, ServiceNow fell 5.77%, Microsoft fell 3.79%, Amazon fell 3.46%, and Salesforce fell 4.14%.
Those are facts, not calls. The common thread was rate sensitivity and multiple pressure. Expensive software and long-duration growth had a rough regular session.
Nvidia held up better, down 1.33%, while the semiconductor ETFs were positive. That fits the idea that the market is still treating parts of the AI hardware supply chain differently from software.
The standout winner was GE Vernova, up 6.77%. That keeps the power grid and energy equipment rotation front and center.
The gold framework got a real test. Gold futures were slightly positive in the New York pit, around $4,342, but miners cracked. GDX fell 3.3%.
That distinction matters. The report's read is that when the dollar move became a Fed-driven, real yield-style move, the higher beta miners finally felt it.
This is different from the earlier Iran dollar noise. In the user's framework, a crisis dollar bid does not automatically break the gold thesis. A policy credibility dollar bid is a cleaner stress test.
The cautious read: the structural gold story did not disappear in one day. Debt math did not change, and the 10-year barely moved. But the minor sell-off showed that a stronger policy-driven dollar can pressure the trade.
Crude fell 1.7% to about $74.76. The Iran de-escalation path and the IEA's longer-term oversupply call both point toward lower oil pressure.
That is disinflationary at the macro level. It is one reason the after-hours market could look at Warsh's hawkish tone and still question whether actual hikes are the base case.
At the same time, the power complex kept working. GE Vernova was the standout, and the report highlights nuclear and grid exposure as rotation magnets.
That supports Thesis 4. AI is not just a software and chip story. It is also a power, grid, turbine, nuclear, and equipment story. Warsh Week did not weaken that theme. If anything, it made the split clearer.
Thesis 1 AI infrastructure. NVIDIA's $25 billion bond sale remained part of the capex story. Tesla's AI 5 chip reportedly taped out, and Snap launched high-priced AR glasses. The AI build-out story stayed alive, though stock reactions varied.
Thesis 2, Incumbents Adapt. Oracle disputed the report about the failed Microsoft cloud capacity deal, while software multiples were under pressure. This remains a messy, evidence-dependent thesis.
Thesis 3 Gold. The minor sell-off looked dollar-driven rather than thesis news-driven. Thesis 4 Energy and Power. GE Vernova and nuclear commentary kept the power complex in the spotlight.
Thesis 5 Pragmatic Multipolarity. Alibaba unveiled AI models for robots, a physical AI crossover, while A-shares again looked firmer than Hong Kong. The ADR versus local market split continues to matter.
Globally, the Asia tape was partly pre-Fed. The Nikkei remained near record territory. Japan exports were up sharply year over year, and China A-shares were firmer while Hong Kong lagged.
The report also notes the Iran memorandum text, including oil sanction waivers and reconstruction financing. The market implication is lower oil pressure and a more disinflationary geopolitical backdrop, assuming the path holds.
There was also a tariff thread. Trump at the G7 threatened a 200% chip tariff if manufacturing does not move to the United States, while TSMC is building advanced packaging capacity in the U.S.
That keeps the multipolarity story alive. Supply chains keep moving, policy risk stays high, and market exposure depends on where a company sits in the map.
The bigger question is whether Warsh actually changed the market regime, or whether Wednesday was an uncertainty shock that the market can fade if data stays soft landing and oil keeps falling.
The regular session said, no guidance is hawkish and high multiple assets should reprice. The after-hours tape said, maybe the language is tougher than the actual policy path.
The read seems to be that markets are separating communication risk from action risk. Communication risk hit prices immediately. Action risk still needs proof in the data.
As always, this is a likelihood game. No one can predict the next print or the next Fed sentence. Just one read of where the setup points today. Hawkish tone, skeptical futures, and a rotation that still favors power over software.
Next, watch whether the after-hours bounce carries into the cash session or fades during quad-witching mechanics. That can be noisy, so one intraday swing should not be overread.
Watch the dollar. If DXY keeps rising on Fed credibility, gold miners can stay under pressure. If the dollar stalls, the structural gold story gets room to reassert itself.
Watch software versus semis and watch power grid names. If software keeps lagging while semis and power hold up, the rotation is becoming more than a one-day reaction.
Final reminder, this video is for educational and entertainment purposes only, not investment advice. Personal market notes only. That's the wrap for Warsh Day.